Well, it's Monday, and that means when we get into this time of day, we usually have a very special guest that shows up, and we indeed do this time around. It is our regular Monday morning guest, the one and only Chris Swift of Swift Trading. He is based in Nashville, and he joins us right now. So we're going to open up our trade again and take another look at our grain market activity. We'll start with the corn here. And on the corn board, we're still weak in the knees here, Chris. We have the March contract down a nickel at 5.79. It just cannot seem to get itself together here this morning. As we move on to the soybean trade with our quotes provided by Bar Chart, you have January down 8. And you have March down 6 3/4 at 12.64.5. So not a very good start to the week here so far, at least in the grain trade anyway. Now, looking at the Chicago wheat market right now, you have the March down 12 1/4 exclamation point. 791.5 is our last trade there. And now we're, what is that, 21 cents off of our overnight high. In the Kansas City market, you currently have the March contract now at 8.14.5. That's 20 cents basically off of its overnight high. We're down 9 3/4 cents from our close on Friday. On the spring wheat market right now, you have the March down 7 1/4 at 10.13.5. Well, Chris, I hate to bring you in on such a negative day here, but maybe you can put some silver lining in this. What is going on today?
Well, you know, really not much of anything, Marlin. And the way we look at it is, thank goodness we're not down 20 or 30 cents like what you would be in bear market conditions. So we're getting towards the end of the year. I think you're just leveling some playing fields here, and probably not going to see a great deal of grain movement for the next several weeks until we get into the first of the year and get all our USDA counts in and see what kind of crop we actually did have, and just kind of make plans for next year.
Someone mentioned earlier in the day that this is typical pre-holiday type trade, when the funds lighten up on positions. Do you agree with that?
I do. Nobody really wants to have a great big heavy position on going into the end of the year because it gets volatile. Sometimes we have moves that we do not expect, like what we saw last week, and nobody really wants to have a great deal of risk exposure in those kinds of thin market conditions.
What about developments outside the U.S.? What's going on? I mean, we've got South American weather, we've got developments in China, we've got the Olympics coming up, we've got Russia lining up on the border of Ukraine. What the heck? What do we do with this?
You know, outside market forces are always scary because we're generally the last ones to know, and the markets tend to be the first ones to know. So those markets tend to move in favor of whatever is fixing to happen there before we ever get that information. So there's a lot of things to watch out for, especially in China. China is our great big grain purchaser there, so we want to make sure that everything is still okay with them. But they're having some real estate issues and just some issues all around.
But we had a sale this morning.
We did. I saw that.
It was 130,000 tons of soybeans to China, but not a big amount. I mean, we have not had those really big purchases for about a year.
And you know, when you look at the price, you know, soybeans at $12, $13 a bushel in comparison to even this time last year, still at 6 and 7. It's almost double the price of it. So I can see where, you know, price is starting to really impact. And I noticed that in the grocery store yesterday. Prices are definitely higher.
Yeah, absolutely. I'll attest to that. Welcome back here in just a moment. We'll talk more with Chris Swift. We'll take a look at our livestock trade next. We are back, and we are talking with Chris Swift of Swift Trading, and he's based right here in Nashville, so we're glad to have him right here in the studio. Chris, we were talking earlier before the break about the fund positioning on grains and what normally happens when you get toward the end of the year. But are they out of position right now on cattle or hogs, in your opinion, or not? Or are they where they normally would be right now?
You know, I'm not real sure. I don't keep up with a lot of that. I know that they had some reduction in the fund movement last week, but when we look at cattle trading, it's changed dramatically. And that change has been we now have fewer cattle to work with, and we have a little bit greater packing capacity. So when we look at that, I think it's going to be harder and harder to go into a bear market environment for several months to come.
All right, let's look at our prices. We'll go to live cattle here first. And on the big board right now, it is still mixed here, Chris. We have the February contract 7 cents higher, and the April contract is 12 cents lower. The February now at 139.02, while the April is at 142.02. Now, keep in mind, we had the cash cattle trade out in the plains at, what was it, 140 to 142 on the top end. Is that right?
That's right.
Here we have the futures well under that What does that mean now moving forward? Which one's going to have to blink?
Well, I think the cash market's the one we really pay attention to, and the futures side of it probably not wanting to put themselves in the same position as what they got into this summer, and that is carrying huge premiums over the cash market, because producers always go to where the highest price is, and whether that highest price is in the futures market or in the cash market, that's where they're going to market their inventory. And right now, the best place to market is on the cash market, because that's where they're offering you the highest price.
Now, we had beef cutout values that came out Friday afternoon from USDA, and I believe we can bring those up on the screen here. But on the beef side, look at this. We were up $2.34 on the choice cuts. Now, this is Friday afternoon. But that's still several dollars under where it was a week ago, isn't it?
It is, but note that it's still 20 some odd dollars above all-time historical price. So $2.55 was the high end for years and years and years up until last year. And so now we still have not been able to come back down on what was once the ceiling.
All right, now let's take a look at our feeder cattle trade. Let's go to the futures board once again. And here on the feeders, even though the corn is lower, the March feeders are down $1.10 at 166. What does that tell you?
You know, and I'm not real sure, because the feeder cattle index has been pretty much stuck around 160 to 162. And the futures haven't really done anything. Again, we're not seeing any big premiums in the futures there in order for producers to market into, and yet they're not really tight enough or into a positive basis where it might help cattle feeders to become the hedgers, where they're buying the inventory cheaper in the future than what they can today.
All right, and then looking at the lean hogs right now, a lot of weakness, but it's all front-loaded. And you have the December down $1.02. February, the most weakness, down $1.70 this morning at 79.80 per hundredweight. That would be off our earlier high by about $1.10 right now. Well, our thanks to Mr. Swift, Chris Swift of Swift Trading here in Nashville. Janet, with that, I'll turn it back to you.